Most investors buy stocks based on hype, tips, or gut feeling. The truth is simple. The market doesn't care about feelings. It cares about numbers. Valuation is how you protect your money. Quick clarification. Valuation just means estimating what a business is worth based on its cash and assets instead of whatever noise is driving the stock price today. In this video, you'll learn 3 tools from the Value Investor's Toolkit: the Graham number, EV/EBITDA, and a simple version of DCF. By the end, you'll be able to run quick checks in minutes to spot overpriced stocks or hidden bargains. And it all starts with one shortcut that can give you an answer in less than 30 seconds. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about different valuation methods. The first tool to keep in your pocket is called the Graham number. It comes from Benjamin Graham, the father of value investing, and is designed as one of the simplest ways to estimate whether a stock price is reasonable. Instead of long spreadsheets or complex formulas, it boils the question down to just 2 numbers. Those 2 numbers are earnings per share, EPS, which is simply the profit each share earned over the last year, and book value per share, BVPS, which is the company's net asset value, assets minus liabilities, divided by all shares outstanding. With just earnings per share and book value per share, the Graham number gives you a conservative upper limit for what an investor should consider paying for a stock. Here's the exact formula. The Graham number equals the square root of 22.5 times earnings per share times book value per share. That constant 22.5 comes directly from Graham's rules of thumb. Never pay more than 15 times earnings and never pay more than 1.5 times book value. Multiply those limits together and you get 22.5. Taking the square root of the product blends earnings power and asset backing into a single ceiling number that represents the maximum fair price. To see it in action, let's walk through an example. Suppose company A trades at $30 per share. Its earnings per share is $5 and its book value per share is $20. Plugging into the formula, 22.5 times 5 times 20 equals 2,250. The square root of that is about 47.4. With the stock at $30, it's trading below the Graham number, suggesting it could be undervalued. Now compare company B at the same share price of $30. But this one only earned $1 per share and its book value per share is $10. Multiply 22.5 times 1 times 10 equals 225. The square root is about 15. That means investors are paying double the Graham number ceiling. Even though both companies trade at $30, the Graham number shows that one price is conservative while the other is aggressive and riskier. This simple test is useful because it forces you to see a stock in context of both profitability and balance sheet strength. A low PE alone can be misleading if the company has weak assets. A low PB might be a trap if earnings are shrinking. The Graham number requires both measures to align, which is why it's a good first-pass screening tool. The method works best for companies where book value actually represents tangible, reliable assets and where earnings are relatively steady. Think manufacturers with factories or financial firms like banks and insurers, where the balance sheet tells an honest story of cash, loans, or physical assets. In these cases, the Graham number often highlights solid bargains that fit Graham's principle of margin of safety. On the other hand, it works much less effectively for fast-moving tech or service companies. Most of their real value comes from intellectual property, software, or brand strength, intangibles that don't show up on the balance sheet. That means their book value per share can look much smaller than their true economic worth, causing the formula to underestimate the price ceiling. For those businesses, the Graham number produces distorted results and should not be your main guide. The real takeaway? The Graham number is a quick first filter. If you're glancing at a stock and want to know if the current price passes a basic value check, this calculation can give you an answer in seconds. It's not enough to make a full investment decision, but it's a powerful way to avoid chasing stocks that are obviously overpriced. Still, there's a gap here. 2 companies might both pass the Graham number test with seemingly fair valuations, yet one could be weighed down by massive debt while the other is nearly debt-free. On paper, they may look equally priced, but financially they're not in the same league. That's the next piece of the puzzle, and it's where our second tool comes in. Imagine lining up 2 companies the market values at $1 billion each. On paper, they look the same, but one is debt-free while the other owes nearly half that amount. To a beginner, these businesses might seem equally priced. In reality, the second company is far riskier. This is exactly where the EV/EBITDA ratio matters because it adjusts for debt, strips away accounting differences, and lets you compare businesses on the strength of their operating performance. Most beginners focus on the popular price-to-earnings ratio, or P. That metric compares stock price to earnings per share. It sounds straightforward, but it leaves out a crucial piece: debt. A stock can look cheap on PE terms, but if the company owes mountains of borrowed money, investors carry far more risk than the PE suggests. EV/EBITDA solves that gap by treating the business as if you were buying the whole thing, equity plus debt minus cash, and then asking how many times its operating cash engine you're paying for. So let's define the pieces clearly. Enterprise value, or EV, is calculated as market capitalization plus total debt minus cash and cash equivalents. Think of this as the sticker price if you wanted to buy the entire company outright. You'd have to purchase all its shares, take responsibility for every dollar of debt, and benefit from whatever cash pile sits on the balance sheet. On the other side of the equation is EBITDA, earnings before interest, taxes, depreciation, and amortization. In plain English, it's how much profit the business makes from its core operations before financing costs, tax obligations, or paper charges like equipment depreciation. Divide enterprise value by EBITDA, and you have a multiple showing how expensive the whole company is relative to the money it generates. Here's a hypothetical example to bring this to life. Suppose both a software firm and an airline report $200 million in EBITDA last year. At first glance, they look similar, but check the math. The software firm has a $1 billion market capitalization, owes little debt, and holds $100 million in cash. Its enterprise value equals $1 billion plus 0 minus $100 million equals $900 million. Divide by $200 million EBITDA, and its EV/EBITDA multiple is about 4.5. That looks relatively inexpensive. Now compare the airline. It also has a $1 billion market cap, but it carries $800 million in debt and has only $50 million in cash. Enterprise value equals $1 billion plus $800 million minus $50 million equals $1.75 billion. Divide by the same $200 million EBITDA, and its ratio jumps to about 8.8. Same earnings, same market cap, but vastly different when you factor in debt. Proof of why EV/EBITDA is so useful. So what's considered attractive? A quick rule of thumb is that an EV/EBITDA ratio below about 10 often signals reasonable value. If you see a multiple around 5, it may hint that the company is undervalued. But context is everything. Industry standards vary widely. Technology companies tend to trade at higher multiples because investors price in growth, while utilities sit lower since their growth is slow but dependable. Airlines, being cyclical and capital intensive, can swing dramatically depending on fuel costs or the economy. Never rely on the number in isolation. Always compare against industry peers before drawing conclusions. It's also important to recognize limitations. EBITDA is not the same as free cash flow. It ignores changes in working capital and the capital expenditures a company must spend to maintain operations. That means EBITDA can overstate how much cash is truly available, especially for companies with heavy reinvestment needs. You should treat this metric as a screening tool, not as a standalone verdict. This ratio doesn't apply everywhere. For banks, insurers, and other financial firms, debt isn't just funding, it's the actual product they sell. In those cases, EV/EBITDA becomes misleading and should be avoided. Here's the bottom line. If you ever spot a stock with a low PE ratio that seems too good to pass up, take one more step. Check the EV/EBITDA multiple. If debt is dragging down the business, the ratio will reveal it. Think of it like inspecting the engine of a used car before driving off the lot. The outside price tag won't show you the hidden issues. Once you learn to read this measure, it becomes a reliable way to avoid debt-trapped companies and protect yourself from false bargains. But while checking the health of today's operations is critical, investing is also about tomorrow. What if you could estimate not just what a company earns today, but what it might generate in the years ahead? Understanding that requires a very different tool, one designed to translate future cash flows into today's fair value. If you want to measure the long-term potential of a business, one of the most reliable frameworks is the discounted cash flow model, often called a DCF. Instead of stopping at today's profits or next quarter's earnings, a DCF projects the company's future cash flows and then asks, how much are those flows worth in today's dollars? This rests on the principle of the time value of money, the idea that $1 today carries more value than $1 later because you can put it to work immediately. The good news is that you don't need advanced math to use a simplified version. At its core, a DCF relies on just 4 steps you can remember. First, forecast the company's future cash flows. Second, calculate the terminal value. Third, choose a discount rate. And fourth, bring everything back to the present to estimate fair value. Let's work through these one at a time. Step 1, forecasting free cash flow. Free cash flow is simply the money left over after running the business and making necessary investments before paying lenders or shareholders. If you ran a bakery, think of this as the leftover cash after buying flour, paying staff, and covering rent, but before distributing any profits or paying off the bank loan. For public companies, analysts usually forecast this over 5 to 10 years using reasonable assumptions about sales growth, profit margins, and reinvestments. Step 2, estimating terminal value. Since we can't forecast year-by-year cash flows infinitely, you need a shortcut to capture everything beyond your projection window. The most common approach is the perpetual growth model, sometimes called the Gordon growth method. Here, you assume that after year 10, the company's cash flows grow at a steady, modest rate forever, like 2 or 3% annually. Another approach is the exit multiple method, where you estimate what the company might sell for at the end of the forecast based on typical valuation multiples in that industry. Either way, terminal value usually accounts for a large share of the overall DCF result, which makes the model very sensitive to assumptions. Even small shifts in the growth rate or discount rate can swing the valuation dramatically. Step 3, choosing a discount rate. Here, you'll often see the weighted average cost of capital, or WACC. In plain English, WACC blends the cost of debt, the interest rate the company pays to borrow, with the required return investors demand for owning the equity. Think of it as a minimum rate of return all investors expect in exchange for putting money into the business. Without this adjustment, you treat a dollar 10 years from now the same as a dollar today, which ignores reality. Step 4, discounting all those amounts back to the present. Each projected cash flow and the terminal value is divided by 1 plus the discount rate raised to however many years into the future you're looking. That adjustment gives you a present value for each future year. Add them all together and you have the company's enterprise value. Subtract net debt and you're left with an estimate of intrinsic equity value, or what a fair share price might be. Let's put numbers behind it with a hypothetical scenario. Imagine a company producing $10 million in free cash flow this year, expected to grow at 3% annually. Analysts use a discount rate of 8%. Run the math and the model might suggest the stock is worth around $80 instead of the $50 it trades at today. But change that discount rate to 12%, and suddenly the estimated value drops closer to $55. Same company, similar assumptions, yet a small input shift changes the outcome dramatically. This is why terminal growth rates and discount rates matter so much. Because the results are sensitive, a practical habit is to always test 2 or 3 versions of your assumptions. Try a base case, a more conservative case, and a more optimistic one. This way, you don't lock yourself into a single number and instead see a realistic range of values. Experienced investors rely on this kind of scenario testing to understand the risks behind their projections and to avoid overconfidence. Here's the takeaway. A DCF forces you to think like a business owner. You stop focusing on just this quarter's earnings multiple and instead ask whether future cash flows justify the market price today. Even in a simplified form, it helps you avoid chasing hype because it grounds your decision in the company's actual cash producing ability. Of course, this tool isn't universal. Just as you wouldn't use the same knife for every task in the kitchen, each valuation method has its own place depending on the type of business you're looking at. Knowing when to pick one tool over another is just as important as knowing how to use them. Think of valuation methods like a toolbox. Each works best for a specific type of company, and reaching for the wrong one can lead to misleading results. This is why choosing the right tool for the right stock is one of the most practical skills you can develop as an investor. Let's break down which tools fit which types of businesses so you can make faster, more accurate calls. A common beginner mistake is trying to force one method across every company. For example, running the Graham number on a high-growth technology company almost always produces an artificially low value because most of its worth is tied up in intangible assets like brand, intellectual property, or software, things book value doesn't capture. On the other side, building a full discounted cash flow for a slow growth utility adds unnecessary complexity because your detailed growth assumptions hardly change the final number. The key is to know which framework aligns naturally with the business in front of you. Let's start with stable dividend-paying companies. Utilities are the classic case here, but many blue-chip consumer goods businesses also qualify. These firms usually offer long operating histories, predictable earnings, and steady dividend payouts. For this group, the Graham number gives you a useful quick check because their assets and profits are tangible and consistent. Another strong choice is the dividend discount model, which values the stock based on the stream of dividends the company will pay in the future. Since dividends from these firms tend to be reliable, you can connect your valuation method directly to the income you expect to receive. Now consider industries that rely heavily on debt or require substantial capital investment. Airlines, automakers, shipping, or large-scale manufacturers. For these, EV/EBITDA is the better lens. Because it includes both debt and cash in the calculation, it levels the playing field between companies financed in different ways. Imagine 2 industrial firms with the same earnings. If one carries a huge debt load while the other barely borrows, a simple PE ratio might make both look similar. EV/EBITDA reveals the real gap, showing you the total cost of owning the whole business and its obligations. This ratio is particularly handy for comparing companies across borders, where financing rules or tax treatment differ. High-growth firms fall into a different category. These are companies like Google, Apple, or newer market disruptors. Their future opportunity creates most of their value. Traditional ratios like PE distort the picture because today's earnings are still small compared to what investors expect tomorrow. Book value also tells you little because their true assets are intangible. In this situation, a simplified DCF model is the tool that makes sense. It forces you to outline how much money the company might generate over time and what that's worth today. While the result is sensitive to your assumptions, it shifts the conversation from hype to measurable scenarios. For financial firms like banks and insurance companies, the rules are different altogether. Debt is the core of their business model. It's not an external risk to strip out, it's what they sell. Using EV or EBITDA here is misleading. What matters more is the price-to-book ratio, which compares their share price to the value of assets on the balance sheet, or a dividend-based model if the firm has a long track record of payouts. These measures reflect the way banks actually create value and the stability of their long-term operations. So here's a simple checklist to keep in mind. Stable dividend-heavy firms use Graham or dividend models. Capital-intensive industries use EV/EBITDA. High-growth tech or disruptors use DCF. Banks and insurers use price-to-book or dividend-based approaches. If you recall just this 4-part framework, you'll already avoid the most common valuation mistakes. Of course, you don't have to lock yourself into using just one method. In fact, the real edge comes from combining them. When more than one tool points to the same conclusion, you gain confidence. When the results diverge, you learn what assumptions carry the most risk. Applying these methods in sequence gives you a fuller picture than relying on any single one. And that brings us to the final piece, how to use the Graham number, EV/EBITDA, and a simple DCF together in a system that acts as a filter, double check, and final projection all in one. This is where the toolkit stops being separate tools and starts working as a safety net. When you put all 3 methods in sequence, you move from quick checks to deeper analysis with much greater clarity. This is where the 3 tools, Graham number, EV/EBITDA, and DCF, work best together as a structured workflow instead of standalone tricks. Using them in order helps you avoid relying on any single measure, which keeps you from missing hidden risks. Here's the step-by-step approach. Step 1, use the Graham number as your first filter. It's fast, straightforward, and tells you right away if a company looks obviously overpriced compared to its earnings and book value. If it fails here, stop and move on. You've probably saved yourself hours of wasted research. Step 2, if the stock passes the initial check, move to EV/EBITDA. This tool shifts the focus to the company's financial structure and cash-generating ability. It tells you whether profits depend on a mountain of debt or whether the business stands on its own. If the ratio is way out of line with peers, you can set the company aside. If it's in a reasonable range, you've confirmed that debt isn't hiding lurking problems. Step 3, run a rough DCF to test long-term expectations. This is where you model in a simple growth path, assign a discount rate, and see if the current price is consistent with the company's ability to generate real cash over the next decade. If the DCF outcome suggests the stock price is based on unrealistic growth, you can flag the risk before money is on the line. Doing it in this order, the filter, the structure check, the long-term test, creates a funnel that narrows the field step by step. A stock that looks promising at the start may not make it through the second or third screen, and that is exactly the point. Cross-checking like this increases your confidence because each tool picks up on a different type of risk. The Graham number flags simple overvaluation, EV/EBITDA exposes leverage issues, and DCF tests whether growth assumptions hold water. Together, they keep you from being misled by surface-level numbers. Let's walk through a simple scenario. Say you're looking at a manufacturing company trading at what seems like a fair price. Based on the Graham number, it passes the first filter. It isn't outrageously overvalued. Encouraged, you move to EV/EBITDA, and the ratio looks acceptable, suggesting its debt isn't abnormally high for the industry. So far, so good. But then you build a simple DCF, and the valuation shows the stock only makes sense if earnings grow 10% per year for a decade. That's an aggressive target for a company in a slow growth sector. With this step, you've uncovered the risk. The stock only looks fairly priced if it achieves unrealistic growth. Without the DCF, you might have stopped earlier and assumed the company was solid value. This process doesn't guarantee perfect predictions, but it shifts the odds in your favor. Just like checking both mirrors in your blind spot before changing lanes, combining 3 viewpoints ensures you won't miss something dangerous. You're not trying to eliminate all uncertainty, you're reducing the chances of being blindsided by obvious red flags. The lesson here is simple. Don't treat these methods as rivals, and don't expect them to give you a single right answer. Each one adds a layer of protection. By applying them in sequence, you filter out hype, dig into financial structure, and sanity check long-term expectations. The result is fewer surprises and stronger confidence in the decisions you do make. And remember, this is exactly how many of the best investors build their edge. They don't rely on gut feelings. They set up systems that catch mistakes before money leaves their pockets. You now have a system that can do the same if you use it consistently. With this framework in place, you're ready to see valuation for what it really is. Not a way to predict the future, but a way to stack the odds in your favor by keeping your decisions anchored to numbers and reality. To recap, the Graham number checks price against earnings and assets, EBITDA reveals debt-adjusted health, and DCF estimates long-term value but relies heavily on your assumptions. To close, remember that valuation is practical only if you use the right tool at the right time. Think of today's lesson as a framework you can start applying this week. Here's the challenge. Pick one stock, grab its financial statements, and run all 3 tools. Then share in the comments which stock you tested and one insight you learned. And if you found this walkthrough useful, hit like and subscribe so you don't miss the next breakdown.